Hello and welcome to a discussion that provides an overview of deferred taxes. Watching this video will help prepare you for class. It is important that you view this before class so we can learn more together in class. After viewing this video, you will be able to identify line items related to deferred taxes on the financial statements. You will be able to state the meaning of a temporary difference and describe the situation that creates deferred tax accounts. Take a look at the balance sheet for JCPenney and locate the line items related to deferred tax. You should notice a deferred tax current asset and a non-current deferred tax liability. A deferred tax asset is similar to a prepaid expense. A deferred tax liability must be paid at some point in the future. Most companies have a current and a non-current deferred tax line. Take a look at the income statement for JCPenney and identify the line items related to income taxes. The line will be the income tax expense. Income tax expense is sometimes called provision for income taxes. Income tax expense includes the portion that must be paid in the current year and the portion that will be paid in future periods. Take a moment and locate the line item on the cash flow statement related to deferred taxes. Deferred taxes is reported in the operating activities section of the cash flow statement as a non-cash expense. It is the difference in the tax expense for the current period and the taxes paid in the current period. The income statement is reported using the accrual basis of accounting. Revenues are recorded when earned and expenses are recorded when incurred. The cash basis of accounting, adjusted for the many IRS rules, is used to report and pay income taxes. Revenues and expenses are reported in different periods under the accrual basis compared to the cash basis. Over time, all revenues will be collected and all expenses will be paid, and the total will be the same under both methods. The difference in the current period only is referred to as a temporary difference because over time, cumulatively, the difference will go away. Let's look at a few common differences that occur when accounting for income tax expenses under the accrual basis and the tax return. Under GAAP, warranty expense is recorded in the same period as the sale. On the tax return, a deduction is not taken until warranties are paid. As a general rule, the IRS does not allow estimated deductions. A temporary difference occurs in the current period because the expense is recorded and the tax deduction is not taken until in the future when the claim is made. This is a temporary difference because in the future, when the claims are paid, the expense on the income statement and the deduction on the tax return will be the same. Another temporary difference is created by depreciation. Most companies use the straight line method or double declining balance to compute depreciation expense reported on the income statement. The IRS provides tables that state the percent of the total cost that can be deducted each year. The amount reported on the income statement each period is different than the amount deducted on the tax return. This is a temporary difference because over time, total accumulated depreciation and the total deducted on the tax return will both be the cost of the asset. Another example of a difference in what is reported on the income statement and what is deducted on the tax return is with bad debt expense. Under GAAP, bad debt expense is estimated and recorded in the period of the sale. On the tax return, a deduction is not taken until the account is written off. A temporary difference occurs in the current period because the expense is recorded and the tax deduction is not taken until in the future when the account is written off. This is a temporary difference because in the future, when the accounts are written off, the total expense on the income statement and the total deduction on the tax return will be the same. Other examples of book tax differences are unearned revenue, unrealized gains and losses, and accrued expenses and prepaids. Revenue is reported on the income statement when it is earned, and taxable income generally increases when cash is collected. Unrealized gains and losses are not reported on the tax return until the investment is sold and the gain or loss is realized. Interest expense that is accrued is not deducted on the tax return until it is paid. Prepaid rent is deducted on the tax return when it is paid, and it is expensed later on the income statement when it is used. If you are not familiar with all the IRS rules for income taxes, it is safe to assume that items are reported on the tax return when the cash is paid or received, unless told otherwise. Income tax expense is computed as income before tax multiplied by the tax rate. Taxes to pay is computed as taxable income multiplied by the same tax rate. Income tax expense will not be equal to income taxes because of the difference in when revenues and expenses are recorded for each. The income statement follows the accrual basis, and the tax return follows the cash basis adjusted for other IRS rules. Income tax expense is debited for the amount calculated using for the income statement. Income tax payable is recorded as a credit for the amount computed on the tax return. The two will not equal. The difference in income tax and income tax payable is recorded to deferred taxes. If more is paid than expensed, a deferred tax asset is created as a debit. If less is paid than expensed, a deferred tax liability is created. Timing differences in when revenues and expenses are reported on the income statement and when revenues and expenses are reported on the tax return create deferred taxes. After viewing this video, you should be able to identify the line items related to deferred taxes on financial statements. You should also be able to state the meaning of a temporary difference and describe the situation that creates deferred tax accounts. The next video will discuss how to determine if deferred tax is an asset or a liability. Thank you for being prepared for class. It is much appreciated.